All right, developing countries around the world spent a record $1.4 trillion to service their foreign debt as their interest costs climbed to a 20-year high in 2023. That's the World Bank's latest international debt report, which was released today. Interest payments surged by nearly a third to $406 billion, squeezing the budgets of many countries in critical areas such as health, education, and the environment. Let's go to Washington now for excerpts from today's launch of the IMF Global Debt Database Report.
The GDD provides comprehensive coverage of public and private debt across the world. The launch comes barely 5 weeks after the annual meetings. On fiscal policy, the message was, it is now time for a strategic pivot. Deficits are high, public debt is very high and rising. It is now above 93% of world GDP. If it continues at the current pace, it will approach 100% of GDP by the end of the decade. If this materializes, it will rise above the pandemic peak. In most countries, additional efforts at fiscal adjustment are necessary to deliver reductions in public debt ratios with high confidence. The time is now. Delays are costly and risky. But the focus today is on private debt. That is on the liability side of the balance sheet of non-financial corporations and households. I will now examine the overall trends in global debt. As the chart shows, last year, global debt declined to 237% of GDP. That is more than 20 percentage points below the pandemic peak. In 2023, public debt turned up by 2 percentage points of GDP after sharp declines in 2021 and 2022. But the rise was more than offset by the fall in private debt. I would like to highlight the persistent fall in private debt since the peak in the year of the pandemic, as you can see in the chart. In 2020, global private debt peaked at 157.4% of GDP. In the following 3 years, it declined 14 percentage points, falling below the pre-pandemic level. This pattern is shared by the US and other countries in the chart. But one exception is China. Private debt turned up in 2022 and increased by about 12.5 percentage points of GDP up to 2023. In 2023, in China, it went above 200% of GDP. Now here we look at both private and public debt and their co-movements. It is interesting to note that for most cases depicted in the chart, public and private debt ratios move together. For the period 2020 to 2022, the only exception is China in 2021, where public debt rose while private debt fell. But in 2023, in the US and emerging markets excluding China, private debt fell while public debt increased. In China, both private and public debt rose. In advanced economies, excluding the US, both fell. What are the main drivers of these developments in private debt? As you can see from the chart, GDP growth and surprise inflation are the most important drivers of falling private debt ratios in the 3 years between 2021 and 2023. The mechanical effect of GDP growth on the debt ratio dominates the result. I want to highlight the importance of surprise inflation that erodes the value of debt assets with fixed returns in nominal terms. Why did private debt continue falling in 2023? In 2023, there was a fall in growth prospects compared with current growth, a growth deceleration or an expected growth deceleration. That seems to have been the main driver of the fall in private debt last year. To visualize the relation, you can look at the chart where we plot the elasticity of private debt to the difference between growth prospects and current growth. This is what is labeled expected acceleration in the chart. As economic prospects brighten compared to the current situation, households and firms are more inclined to resort to debt financing. In recent years, deteriorating growth prospects presented in our recent World Economic Outlook have made this logic operate in reverse. The importance of growth prospects allows me to conclude with another reference to an important message from the annual meetings. It is time for a pivot to growth. Fiscal and other structural policies can help deliver sustainable and inclusive growth. The Spring 2024 Fiscal Monitor focused on policies to favor research and innovation. Other important priorities are good governance and accountability, the tax system and education, and also health.
Now that markets have reopened, I want to discuss how the differences between public and private will likely manifest in the coming years and how we believe that private debt markets will outpace public. In the more traditional private credit markets, which focus on corporate borrowers raising working capital and funding M&A, including both broadly syndicated and direct lending, there's no doubt that the non-bank financial institution is back in action, right? CLO market, broadly syndicated and middle market has had record issuance this year. We rated our first middle market CLO in Europe, which was issued via Barings. Traditional private credit, though, has challenges to face, particularly how to exit from large inventory of companies that were bought at high leverage in a low interest rate environment. This requires a full reopening of the M&A market, which has picked up, but it remains far below historic levels. We're at about 17% in the year to date versus 50% in 2021. Public and private need the new money of M&A. Private in particular, though, needs M&A as an exit strategy because private equity funds must at some point return capital to equity holders. We know and have seen secondaries, continuation funds, fund financing structures become more common to provide liquidity. They cannot solve the problem. There has to be a return of M&A. Private equity has to find a strategy to grow companies in a higher interest rate environment. And then outside of that traditional private credit world, we know private funding is looking at newer uncharted territories, securitizations, infrastructure. In this higher for longer world, with the amount of private funding that needs to be put to work, managers cannot rely upon beta. The search for alpha is pushing private funding well beyond the traditional private credit markets into securitizations and infrastructure. These are complex transactions to structure and manage. They generate the complexity premium, which is what managers need. But this all means that this private funding, the size of private debt, is here to stay. It will increase and diversify. It will help to bridge funding gaps, but it will also create challenges that we need to think about, the implications, right? Victor talked about where we need to invest going forward, and this is really important.
What you see on the external front is a big decline in the ratio of global external debt to GDP, which was triggered by fundamentally the big increase in prices that we have seen over especially 2022 and 2023. That had the effect of increasing the denominator of the ratio of debt to GDP, but also the concomitant increase in long-term interest rates had a big effect on the value of outstanding bonds, reducing the value of outstanding bonds, and that also contributed to reduce the overall ratio of debt to GDP. The database, the cross-border data on debt does include debt of the financial sector as well, and which is not part of the global debt database, which focuses on non-financial firms. So the two are not exactly comparable. But I would like to highlight a couple of elements which are common to the external component and to the domestic component, which I think are really important. The first one, again, is the importance of inflation. Note that surprise inflation is not just the inflation that was not expected, say, at the beginning of the year. It is the inflation that was not expected at the time the debt was contracted. Because a lot of that is long-term, think of US private debt, think of US households with a 30-year fixed-rate mortgage. Then an increase in prices reduces the ratio of that debt to GDP without interest rates offsetting that for borrowers that are on a fixed rate. So that effect is very important for countries where inflation and interest rates increase. What are those countries? Most emerging economies, all advanced economies, with the partial exception of Japan. Why is China having a different trend? Well, China did not have an increase in inflation. In fact, the GDP deflator was negative in 2023. So that moved the ratio the opposite direction. And interest rates did not rise, long-term interest rates, as they did in other advanced economies.